Hello, this is Doug Johnson, Senior Investment Strategist here with HCM, and I want to welcome you to the market update. As a quick reminder, we do have two versions of this presentation. One is the shorter executive summary, with the other being the longer, more detailed presentation. This is, in fact, the longer presentation. So if you have clicked on this by accident or you don't want to sit through 20 or 25 minutes worth of information, I would advise you to go to the website and click on the executive summary. If not, I want to thank you for joining us. We can go ahead and get started. So I'll run through these bullet points fairly quickly so we can spend some more time on the charts that we've presented. But on the equity side, as many of you know, we have reduced our equity targets by 20% from neutral. So, for example, if as a neutral model, you had a 60-40 or a 60% equity, 40% fixed income, your model target is now switched to 40% stock, 60% fixed income. The extreme volatility that we've seen in the first quarter resulted in the worst first quarter for the S&P 500 on record. Not surprisingly, the sectors that would normally outperform in a bear market did, and the sectors that normally don't perform well did not. So you have information technology, healthcare, and staples were the best performers, while energy and financials were the worst. We remain slightly underweight international versus our U.S. positioning as this virus has truly gone global. We did see the beginning of some opportunities in the international markets, particularly emerging markets, after the phase one China deal was signed, but the spread of the virus has kind of undone all that. So our positioning remains slightly underweight international versus U.S. On the equity side. On the bond side, our portfolio duration remains slightly below benchmark levels. Just as a reminder, duration is a fancy way to describe the relationship between interest rates and price movements. So, for example, if you had a portfolio that had a duration of 5 and interest rates went up 1%, that portfolio of bonds would be reduced in price by approximately 5%, and vice versa. So the core portion of our fixed income positioning held up quite well during this, while the spread sectors, things like high yield, emerging markets, credit, have underperformed, and frankly not unsurprising there. We have seen some interesting dislocations in the municipal market. Muni yields and treasury yields usually trade not necessarily on top of each other, but at somewhat of a close percentage. Municipals have been trading at anywhere from 110% to 120% of treasury yields over the past several years, and they ballooned as high as 250% of treasury yields at the height of the crisis. So that dislocation is I believe the highest we've ever seen, and we've seen some stability returning in the muni market, but we think there's further consolidation between that spread going forward. Rates have been cut to zero, and we expect them to stay there for the remainder of the crisis. Economically, growth forecasts have essentially collapsed as the measures to stop the spread of the virus have also essentially shut the economy down. So it's really no surprise that we've seen growth forecasts be reduced down so significantly. U.S. recession is extremely likely at this point. I think the only question that remains is what will the severity be and what will the duration be? Inflation remains extremely low, though I think there are concerns with the amount of fiscal and monetary stimulus that we're injecting into the economy, close to $10 trillion as of right now, with the possibility of more going forward. Politically, issues that were kind of starting to heat up before all this started with the presidential race has quite frankly just taken a back seat to the news flow as the virus continues to dominate everything. As we get closer to the election, though, we do expect it to move a little bit more into the forefront, under the assumption that the virus news will slow eventually. So risks going forward, obviously there's a lot. We think the main ones would be U.S. recession turning into a depression if the containment measures either fail completely or they succeed, but at the same time shut the economy down for a significant period of time. Any additional downward pressure that we would see on stock prices, mainly related to earnings. We still think that earnings forecasts are quite frankly too optimistic at the moment. What those will actually be, I don't think anyone has any idea. But if they come in much lower than expected, you could see a significant repricing of risk on the stock side lower. Loss in the belief that central bank stimulus can provide significant support for the markets. So for the past 11 years, every kind of blip on the radar that we've seen in this rally has been met with some kind of central bank action or language that has kind of provided a net, so to speak, under risk assets. Now central banks are frankly all in or very, very close to all in with what they can do. So far, it seemed to have stemmed the tide of the sell-off. I don't think it's a coincidence that the initial market bottom right now was the day after that the Fed announced an unlimited quantitative easing program. But if the confidence in these programs or the credibility of not only the Fed but other central banks around the world were to wane at all, it could take a very significant psychological support out of the market. And then finally, any unexpected increase in inflation that we would see. So this first chart we've used already in one of the market insights, but I think it's a pretty powerful visual to see exactly what kind of carnage that we witnessed during this sell-off that we've seen. So the first quarter produced the fastest bear market in history from an all-time high and only needed 18 trading days to do so. So if you take a look at this, I think there's two things to notice. One is the blue line represents the Great Depression, which is 1929, which was still pretty violent, but was closer to 30 days. And what a lot of people don't realize is that there was actually a pretty significant rally during the Great Depression after that initial sell-off before things really started a slow, steady, severe move down. And then you've got 1987, which was more of a one-day event, quite frankly, a kind of a technical setup in the market that caused approximately a 23% loss in one trading day. I believe it was 23%, maybe a little bit higher than that. But we've had circuit breakers put in since then to avoid anything like that happening. So you can kind of see a comparison to the two other major quick drawdowns, and this is the fastest, which is it's quite extraordinary. Now, if you look at some of the gray lines or the darker black lines there, you can see that we've had other 20% drawdowns from all-time highs, but they've taken much longer. We've talked a lot about 2007, 2008, and kind of how it relates to this, and I think there's a lot of good points of comparison. But in 2007, it took almost 190 days, almost a half a year, to get that first 20% drawdown. So what we've seen in the first quarter of this is truly historic. Now, we've mentioned the Fed at the beginning of the presentation, and I think this visual really shows what kind of response that they've given. You may have heard me say that this chart looks almost cartoonish, because I think it kind of does. But after slowly reducing their balance sheet at the beginning of 2018 down to levels that were 3.75 trillion, with an increase up right into the beginning of 2020 then you've got a sideways, and then you just have absolute vertical line. Now, the interesting part about this is this chart is basically that vertical line is going higher and higher and higher every single day. So the first time that I put this out or created this slide deck, I had to update the chart today, and it was significantly different. But you can see just the amount of monetary stimulus that's being injected by the Federal Reserve is truly astronomical. There's still no real definitive answer on when they're going to stop with unlimited quantitative easing. I've seen statistics that are saying that they're buying essentially $1 million of securities every second. So I think what they're trying to do here is serve two functions. One, they want to make sure that the bond market, the money market, the credit markets remain liquid. And they've implicitly gone in there and said, we are going to purchase assets in these markets to ensure that there's a buyer. And I think that they've been effective in backing up those markets and making sure that they function, maybe not perfectly, but they function enough. The other thing is that, and for the past 11 years, we've seen this almost a psychological backing for investors that if something goes wrong, if there's a significant sell-off, if there's risk to risk assets, essentially, in a significant way, that the Fed is going to do something. They're going to step in and try to avoid disaster. I would say this is certainly doing something, as you can see by the vertical line on the chart, and it's put back that psychological floor, so to speak, for some investors to say, hey, this isn't going to get a whole lot worse because the Fed's not going to let it. Now, whether or not that holds true, it's yet to be seen. But I think so far the two things that this has accomplished is functioning credit markets, functioning money markets, functioning bond markets, and reintroducing this psychological support for investors. On the economic front, weekly jobless claims have spiked to levels that are unprecedented by a factor of 10 in some instances. So we've had 9.9 million claims in 2 weeks, and if you take a look at the red line that kind of goes horizontally towards the bottom, it marks other high points that we've seen in this number. So 1975, 575,000 was the old high. Now those vertical gray bars represent times of recessions. Fast forward to 1983, you had 695,000, 2001, 517, and then finally in 2008, we had 665,000. So that was the peak in initial unemployment claims during those recessions. So over the past 2 weeks, we've had 3.2 million, and then last week we had 6.6 million, with another number expected to come out tomorrow. Tomorrow being Thursday, April 9th. So these are truly astronomical numbers, and you can see in most cases you have to rescale the chart just to be able to fit them on there. What this is going to mean going forward, I think everybody who's concerned about the economy slipping into a depressionary state, this is one of the perfect stats to look at, is the sense that you've got just an unbelievable amount of people now out of work. And when you have that many people out of work, the demand destruction is significant. And the question is, how quickly are we going to get these people back to work? And are they going to be able to go back to the same job that they had before? The question to the first one, I think, is unknown. And the second one, it's hard to believe that 10 million people who have just filed a jobless claim report is going to go back to their same job with no strings attached when this is all over. I think too, these numbers are probably being a little bit underreported quite frankly, just because the system has been so bogged down. Now, in terms of scenarios for how the economy could possibly recover and ultimately how that could affect the market. Now, I will say that the market and the economy have become somewhat detached. They don't necessarily need to act in unison over the short term, but the wider the dislocation gets, the more likely it is that they're going to kind of come back together, so to speak. So right now we've had the initial sell-off, and then you've had this reflexive rally that we've seen, which so far has been pretty strong, but we've yet to see the true destruction of the economic numbers yet. We've seen a few with the jobless claims, but we haven't really gotten GDP numbers or earnings numbers from companies yet. So as we look at the four kind of scenarios of what what economic recovery could look like. So case one, you've got this, what we call a square root. So you've got a steep decline in output and employment, and then a rebound in Q3, Q4 as stimulus backstops the economic fall, and then you get kind of a slow growth after that. Case two would be a U. So you get a steep decline in the first half of the year, you'd get stabilization in the second half of the year, and then you'd get a pretty good recovery in the latter half of 2020 and 2021. Now, in this scenario, it would take a year or more to regain some of that lost output, and then you'd see slow growth after that. Now, case three and four are respectively the best and the worst. So the best scenario would be a V-shaped recovery. So you get a steep decline in output, unemployment in the first half, followed by a sharp rebound in Q3 to essentially pre-virus conditions. The economy, recovers all the lost output by the end of the year, and then the stimulus will fuel strong growth after that. Now, I think this is the one everybody's hoping for, obviously, and I think in certain ways the market is almost trading like this is going to happen. Ironically, while this is the best case scenario, I think from an economic standpoint, it's probably one of the least likely, simply because flipping a switch to just turn the economy back on after all this demand destructions take place is going to be a pretty hard sell, so to speak. I'm certainly rooting for the V-shaped recovery, but I'm definitely not counting on it with the data that we've seen right now. And then finally, the case four is the worst case scenario with the L-shaped recovery, where you get a steep decline in output and employment. The virus would persist, social distancing would persist. All of the stimulus, both monetary and fiscal, would not do a whole lot to support the economy. You get a further credit crisis. You essentially get long-term damage to households and businesses, bankruptcies, layoffs, and then you get kind of a stagnation that sets in. I think a lot of people wouldn't admit, but the L-shaped is kind of the scenario that we actually saw in 2008, or at least coming out of that. We saw a massive drop in economic activity. You did see initially damage to households. You saw businesses fold. You saw bonds default. You kind of saw the normal recession cleanse the system, so to speak. And then I think the market came back very strongly. But if you refer to our last quarter's deck, we have a slide in there that shows that while this has been the longest expansion on record, it's also been one of the weakest. So, the L shape being the worst case scenario doesn't necessarily mean that the market is going to follow suit. It's more of an economic scenario. But again, they could follow hand in hand if the recovery is not strong enough, or if the drawdown is significantly weak. So both high yield bond spreads and corporate bond spreads have been in the news a lot during this, as initially both high yield and corporate bond prices went through some massive volatility, some of the highest we've ever seen. when the Fed stepped in and said that they were going to support the credit market, that calmed things down a little bit in the investment grade space. It actually calmed things down a little bit in the high yield space. But we're probably, probably weeks, if not months away from the peak that we would see in defaults for high yield bonds, and maybe even spreads for those products. Now, when we talk about spreads, it's really just the difference between what the yield is on a bond versus what the yield is on a comparable treasury. So when we look at this dark blue line spiking up to 954, it just means that the yield on a high yield bond is 954 basis points, or 9.54% higher than a yield on a comparable treasury. So pretty significant spike up, still not at the levels that we saw at the depths of the credit crisis. I think corporate bond spreads topped out around 600 basis points, and then high yield was close to 2,000. Now, some people may be asking, why does the spreads matter? Well, first of all, as spreads move higher, it means that the yields on bonds are moving higher. As the yields on bonds are moving higher, that means the prices on those bonds are going lower. And bonds really represent, true economics, so to speak. They're more of a representation of the health of a company, so to speak, and whether or not they can continue to pay interest, maintain their cash flows, basically stay solvent, so to speak. So the other thing is that if bond yields widen out and those bonds come due, companies are going to have a hard time refinancing that debt. So what happens a lot of times is companies got a bond issue due at a yield of X. They look to the market and say, okay, can we just roll this forward by essentially refinancing it, similar to what you would do with your mortgage. The issue becomes if your mortgage is at 3.5% and you want to try to refinance it, now the cost is 6.5%. You may not be able to afford that. And with the mortgage, you're not forced to refinance it. In the bond space, you're forced to pay back that bond when it comes due. And if companies don't have the cash flow to pay that, and they don't have the ability to refinance it in the market, it creates problems, and that's what ultimately leads to bankruptcy. So these high levels of yields in the bond market, specifically in the high yield, is not a very healthy development. The last slide that I wanted to show, there's a lot going on, and I understand it's kind of hard to see it, but I'll walk you through it. And it's really the small differences in portfolio allocations that I think maybe can go underappreciated in times like this. So if you look at the top box on this, this shows the value on October 2007, which was the old S&P 500 peak, of a portfolio that is 100% S&P 500, so that's the green line, a 60-40 blend of stocks and bonds in the light blue, and then a 40-60 stock bond in the dark blue. So the dark blue is obviously the most conservative. So as you see those lines track down to the first vertical dotted line, March 2009. So that was the bottom of the great financial crisis. And it shows what the values would be. And not surprisingly, the portfolio with the highest bond allocation obviously maintained the highest value, and then all the way down to the S&P 500 one. So I think the point to take away from this as we move to the next vertical line is that I think a lot of times investors get caught up with this need to participate in 100% of the recovery. Now, our goal is always, when we do anything tactical, is to reinvest those funds at a lower price in order to enhance returns. All under the assumption that, we're probably never going to catch the very, very bottom. But what I think is interesting here, if you look at this, November 2009 was the level where the 40-60 portfolio would have gotten back to its original value. So, getting back to even is never an investment strategy. But what this chart shows is that, if you don't lose as much on the way down, you don't have to make as much on the way up. And this need to re-risk and jump into the rally the minute we see something go up, it doesn't necessarily have to be that way to still get back to levels that you were in the past. So going to the next so November 2009, then we moved to October 2010. So that's when the 60-40 portfolio got back to even. And then finally, the S&P 500 portfolio got back to even all the way in March 2012. So almost 3 years after the bottom, even with a 100% equity portfolio, they got to participate fully in the rally that we saw afterwards. Still took the longest time to get back to even. And then if you take it further out, it was almost till October of 2016 that we saw the all stock portfolio finally overtake both of the stock bond portfolios. So almost 9 years after the peak is when that all stock portfolio finally overtook the other one. So the takeaway in here is that bonds and bond allocations can be very important to clients' portfolios in times of significant volatility, and the kind of need to be super risky coming right out of the gate during the recovery. Yes, it will help you immensely generate some additional return, but the portfolio that kind of stays within its constructs can be just as effective, if not more effective, in values getting back to where they were. So as a quick summary, we have made the decision to reduce risk in our portfolios by approximately 20% from our neutral model targets. The decision's obviously been made with the concern that we see an extremely high likelihood of recession going forward, with the I hate to say it, with the outside chance that you could see very depression-like economic numbers coming out over the next few months. I think that if we could see improvement not only in the virus counts, but also the economic figures, and then also the employment figures, we need to see those jobs begin to come back, because ultimately that's what's going to drive economic growth and begin to spur that demand back, and eventually lead to markets that can continue to trend higher. But I think until we check those boxes off, until we get past the uncertainty of what earnings might look like from corporations, it's going to be difficult to move off of that defensive positioning with any level of conviction. So again, I'd like to thank you for joining us for this market update. As always, if you have any questions, comments, concerns, please reach out to your advisors, and we will make sure that we get those questions answered as quickly as we can.